How you should invest during economic chaos, according to Warren Buffett. I'm sure if you are watching this video, you know full well who Warren Buffett is. Some call him the Oracle of Omaha. He is without doubt one of the greatest investors of our lifetime. And his painfully obvious advice and how he keeps things simple is the reason why he has been so successful as an investor throughout his career. In this video, we're going to look at how you should be investing during some key economic chaos which is on the horizon. These are all real tips from Warren Buffett. But as always, I need to preface this with the fact that I am not a financial advisor, and if you're looking to invest, you should consult a financial professional. That said, let's look at the advice from Warren Buffett for how you should invest during these turbulent times and some key hard times in the market, and what we can do to navigate around them. Warren believes that some people are not emotionally or psychologically fit to own stocks, but goes on to say that they could be if they were educated on what they are really buying. What you are really buying when you invest in the stock market is part of a business. When you are buying stocks and shares, they are actually small pieces of the company which you own based on the number of stocks or shares you have in a particular business. So, as with any business, if that company is performing well, its stock price will go up. If it does poorly, then the stock price would go down. So you need to find good companies with a good track record of increasing their share price, having good foundations, and stick with them for the long term. Warren Buffett took over the holding company Berkshire Hathaway in 1965, and since then has averaged a return on the investments made by his company of 20% per year. This, in contrary, is double the average return of 10.2% per year of the S&P 500, which is pretty good in itself. But when you look into the overall percentage gained year to date, 2020 is even more mind-blowing. Berkshire Hathaway's overall percentage gain from 1964 to 2020 was 2.8 million%, compared to the S&P 500's of only 23,454% over the same period. So, he really is a guy you should take advice from. Warren Buffett's advice around this financial success is to keep things simple and to follow the 4 key principles of investing which he lives by, which are: 1. You need to understand the business you're investing in. 2. You need the business to have a durable competitive advantage. 3. You need to ensure that the business has management integrity and talent. 4. You need to ensure a margin of safety on the value of the price it should sit between. Now, this may be simple advice, but you'd be surprised to know that not many people follow it. You can see where people like Warren Buffett have already trodden a path to success. You should be able to see what they have done and copy it, but most people tend to overcomplicate investing, like they do with most things in life. This simple approach is an approach which Warren Buffett sticks to religiously, no matter what is going on in the market, no matter if it's a bear or a bull market. If a company meets the criteria of the 4 rules above, then it will be a sound investment over the long term. As everyone knows, at time of posting this video, we are facing a dire global financial and economic climate. With the cost of living crisis, inflation as high as it's been for 40 years, previously overvalued stock prices, interest rate hikes, and even a crypto crash in recent months, it's not easy to navigate these turbulent times, for us mere mortals anyway. But Warren Buffett does shed some light on some of these key challenges we're facing, and what to do to get the best outcome for your portfolio during some of these tough financial times. Overvalued stock markets. This is what Warren Buffett had to say in his 2019 letter to shareholders on how to invest during a period where stocks seem to be overvalued. In the years ahead, we hope to move much of our excess liquidity into businesses which Berkshire will permanently own. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects. While Warren Buffett is trying to buy whole businesses, and we're only trying to buy small percentages of these businesses, the philosophy for investing is the same. We're just on a smaller scale. So, the key takeaway here is that Warren Buffett can see that the market is overpriced. So he's not just putting money into overvalued stocks. Rather, he is holding on and staying liquid, another term for having more cash in the bank than invested, until the right business comes along, at the right price. Berkshire Hathaway's cash reserves have gone from $84.4 billion in Q3 2016 to $149.2 billion in Q3 2021, which means that Berkshire is not in a rush to just throw money at overvalued stocks for the sake of investing. They wait until they find a business which meets the 4 rules set out earlier. Warren Buffett's partner at Berkshire Hathaway, Charlie Munger, is quoted as saying, "You don't make money when you buy, and you don't make money when you sell. You make money when you wait." What he is saying is that you don't need to throw your money into overvalued stocks. You need to wait until the right stocks come along, which meet the 4 rules of investing Warren discussed earlier. Buffett is an advocate for only investing in stocks which meet his 4 rules, and is quoted as saying, "3 wonderful businesses are more than you need in this life to do very well." What Warren Buffett means here is that you don't need every stock you're investing in to go to the moon. You only need very few good businesses which do exceptionally well to massively impact your portfolio in a positive way. So, be patient. Use the 4 rules Warren set out above and find the right stocks to hold for the long term. This will do you more favors than blindly jumping into every stock you hear someone talk about on the bus for fear of missing out. If you are still watching this video, congratulations. You're one of the few who dedicates the time to become financially free. If you want to learn more about becoming financially free, then please hit the like button and subscribe. Another form of investing which Warren Buffett often advises on is passive investing, or dollar cost averaging as it is sometimes referred to as. Dollar cost averaging is an investment strategy where an investor divides up the total amount to be invested over a given time period in an effort to reduce the impact of volatility on the overall purchase. The purchase of the stock or asset is executed regardless of the price and at regular intervals, i.e., monthly. In effect, this strategy removes much of the detailed work of attempting to time the market to make purchases of stocks at the best prices. If the stock is high, you purchase less. If the stock is low, you purchase more, therefore averaging out the price over your whole portfolio of a given stock. Warren Buffett advises that the best way to think about your investments in the stock market is to not think about them. Warren Buffett is quoted as saying, "The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a newspaper headline and never look at that stock, never think about it again. I pointed out that if you had put $10,000 into a mutual fund and reinvested dividends, it would be worth $51 million today." The nature of investing using the dollar cost averaging strategy is to buy the same assets no matter what is going on in the markets, and don't even look at the values. Just keep pumping that money in week after week, month after month, year after year, no matter if the markets are high, low, or average, and no matter what is going on in the world. This is how you win. You win over the long term, not over the short term. By doing this over the long term, you're tracking the market averages, and therefore your returns over the long term will be the market average, which in the case of the S&P 500 will be about 10.2% per year. Let's look at how Warren Buffett invests during high levels of inflation. Warren Buffett, referring to the high levels of inflation and quantitative easing, says, "It's a fascinating time because we've never really seen what shoveling this amount of money into the economy while following the current government monetary policy will actually do to it. With close to zero interest rates, it's enormously pleasant, but in economics, you need to remember that you can never do one thing. You always have to look to the future to say, and then what?" This was said by Buffett at a conference in 2021 where he was giving a keynote speech. And what do you know? He was right. This year in 2022, inflation has finally caught up with us. All that money printing and stimulus for the economy has resulted in rising interest rates and inflation running higher than it's been in years. So what do we do as investors about rising inflation? Well, back in 1982, when inflation was just returning to normal levels after hitting 20%, Warren Buffett addressed this in his annual announcement to shareholders and told us exactly the businesses we should be investing in during inflationary periods. He quoted, "Such favored businesses must have 2 characteristics. 1, an ability to increase prices rather easily, even when product demand is flat and capacity is not utilized, without fear of loss of either market share or unit volume. And 2, an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital." So, for number one, you're looking for businesses like Apple, Google, Coca-Cola, and Tesla. All of these businesses will be able to increase their prices without loss to market share. People don't turn to other competitors of theirs trying to obtain a cheaper price. They will pay the price increase, and therefore, these companies will not lose market share. So, businesses to invest in during inflationary periods are businesses with a competitive advantage. Secondly, look for the companies with the ability to accommodate large dollar volume increases without having to spend a lot of capital to increase volume. So you need to look for businesses which have a very scalable business model. Businesses like Meta, who can make more money simply increasing the frequency of showing ads, or Google, who can simply show more ads on YouTube, for example. They don't have to spend a lot more capital to increase the dollar volume from sales. On the other hand, if a company such as Mercedes wants to double their sales volume, they will require a lot more infrastructure and capital investment to do so. They may need to acquire new land to build more factories and employ more staff and buy more machines to increase commercial volume. Looking at investing during times of high interest rates. Warren Buffett on interest rates says, basically, interest rates are to the value of assets what gravity is to matter. What Warren Buffett is saying is that the interest rates set the value of all assets that produce money. This explains why the market was so high in 2021 and there is now a correction with markets dropping. Because interest rates were at zero, the money management funds are not getting a return in bonds. Normally, the money they would have in bonds finds its way into the stock market, which pushes up the value of the market. This is what Warren Buffett is referring to. The lower gravity is, the easier it is to jump or to rise. The same as in the stock market. The lower the interest rates are, the easier it is for markets to rise. Therefore, as the interest rates are now returning to higher levels, the stock market is on a downward trend. So, take on the advice of this seasoned pro in investing, Warren Buffett, and follow the tips he has given to successfully navigate your way through these turbulent times in the market ahead. Have a look at the next video to keep on building your financial knowledge. Be sure to subscribe, and we'll see you in the next one. Thanks for watching.